G'day all, welcome back to Money in the Tank, episode 65 on the retake because we had some technical difficulties last week when we came to you all. So we thought we'd jump up again and redo 65 with a recap on all the craziness that's been going on in the markets of late.
Arnie's back. Arnie's back as well. So
Arnie's back as well. Arnie missed the last one, so he didn't miss anything really, Arnie. Why the market's been having such a crazy run. Crypto's had a run, come off a little bit of late. Talk about the AI boom and what's been going on there and how that's changed the game. We'll talk about the interest rates as well. So we've got the interest rate movements that have come up, both Australia and the Fed late last week, I think it was, in terms of J-Pow and what a hawkish pause means, which is a strange terminology. But without further ado, that's what's coming up in the episode today. So I wanted to introduce ourselves. My name's Joel Seach, Principal Advisor, Harpel FG. To my right,
I think that's me, and I'm Arnie, Finance Professional.
Thank you, it's yours, Arnie. And Brad Tabone, Investor and Journalist.
So we're looking forward to bringing the episode today to you guys with a whole bunch of information, always general in nature, as with all these things. So seek your own personal advice. This is just for educational purposes, and we try to bring things to our listeners out there, the tankers, with easy to understand language when it comes to all things money. So without further ado, we want to get stuck into the Rivkin's rules of the day. So we've got a page up here, which I'm going to redo from last week because Arnie missed this one. So it'll be interesting to hear Arnie's take. So this is always an interesting chapter, this one on Renee's book. It's Renee on Sex and Relationships is this chapter. So you always get some interesting facts from Renee.
It's a miss, one might say.
Each member of a partnership must have his or her own space. And the second one is never expect perfection in a marriage. It almost never exists.
Yeah, it's not bad.
Yeah, no, I like that. And I mean, Rivkin, I think space in a partnership, absolutely. I feel like that takes many forms. You know, people meme about the man cave, but women as well, having a space that they can, do something that's introspective and a little bit introverted or just, away from your partner is a good thing. I sometimes wonder about how couples go that work together. Like I work with a few couples who are in each other's vicinity literally 24/7.
Depends on the work together, right? Because me and Ames work together at NAB and at Hammertech in the US. Right?
Yeah.
But when you don't work, as in, if you're not working on the same job and responsibility, but you're in the same space, doesn't really matter because you're working with different people. I think if you're working on the same project or the same thing, like say if you own a business together, I think that's when it'll get tough.
Yeah, I know couples in both scenarios, and that last one, no such thing as a perfect marriage. Well, that's just common sense. There's no such thing as a perfect anything, really. It's just like, you can get close though, and you got to strive for it because that's what makes it good. Like your ideals to strive towards perfection. But yeah, common sense, dropping common sense.
Yeah, common sense one, perfection. It's never perfect. You always got to work your way through the journey of the ups and downs, and that's what makes life.
And that's the beauty of it as well, Jolie.
That's it. Beauty of life, mate.
If you have nothing to strive for.
I just love these pods in a turn like this.
Love
philosophical tank.
Philosophical tank, yes. We bring it all. We bring versatility to not just finance topics. We talk relationship advice as well. And we're not psychologists, so don't expect anything of that nature. But seek your own psychological help as you require and need help counselling. Anyway, back to the episode of finance. So as we said at the start of the episode, we want to touch on the interest rates of what's been going on of late because there's been a bit happening there before we get stuck into the AI stuff. And don't forget to hang around at the end for a 50-50. Arnie, where can the tankers get us at as well? And what do we want to get from them from a subscribing standpoint?
Yeah, please get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And on YouTube, if you can like, comment, subscribe, and click the bell, because then you'll see when we release an episode. And we love the interaction. Throw us a 50-50, throw us a Q&A, or just give us some feedback. So yeah, cheers, tankers.
Right, and also we had a listener question from last week, which we wanted to bring back up again. We forgot to mention to Arnie at the rundown of the show. Yes, we do prepare for this. There's a question from Mark regarding fixed loan terms coming off this year and what they should be doing around fixed loans. So We'll obviously chat to that generally in nature about fixed loans and how they work and where the markets, where the interest rates might be going in the future. So we'll cover that off at the end of the episode too. So thanks for sending in your questions, listeners, and Mark for this one this week. It's great. So without further ado, RBA, I think it was last week, the week before, raised rates by 25 basis points to 4.1%. I think this one was more of a surprise raise. I think the economists and the banks largely were tipping towards the scale of not raising in the month of June. But the RBA have come out and raised 25 basis points. And then the minutes have just come out the other day talking about Governor Lowe, and they were interesting minutes because I think they were on the fence around what they felt they were going to do with interest rates when they did raise them last week. So just having a look at the board minutes. So June 6th was the meeting, and they raised the rates, which surprised the market. And the central bank said in the minutes that it was necessary to raise interest rates in June to ensure high inflation did not become embedded in wage and price expectations. And after the release of those minutes, the Westpac, NAB, ANZ, and I think CBA as well reiterated the predictions that the bank would raise rates again in July. And I've also read somewhere else July and August, which is very interesting. But the actual minutes themselves, the meeting showed in June it was finely balanced. So it's sort of interesting that the minutes are saying that it was finely balanced, but then the big banks have come out and predicting that they're going to raise again in July and maybe August. So what are your boys' thoughts on that? We'll go to Arnie first.
Yeah, I think you're right that they sort of did signal that they were close to a pause. I think they were taking into account our domestic economic conditions, among other things. But when they were talking about that, I know that they mentioned that there has been a significant slowdown in the first half of this year domestically about what people are spending on. And at the same time, like in conjunction with that consumption, you're also seeing the price of housing, so house prices and rents increasing as well. So people are sort of getting hit doubly, like they're having to spend more on shelter, but also can't spend as much as they would like to on retail consumption and things like that. So whether or not they will hike again, I think it's all going to be data driven and dependent, and they're going to have to sort of see, is it coming off as quickly as we would like to? And at the moment, it's not. Like, it's different to other places in the world. I know we're going to discuss America soon, but it's just that's my sort of take on it at the moment, is that I think they will probably have to hike another 1 or 2 times because our cash rate is lagging a lot of other developed economies, and we're just not seeing the impacts that we want to see. Brad?
Yeah, look, I think we all actually said it. Even though the economists are saying they're going to pause, I think from memory, we all called that they're going to keep going. I think the reason was unemployment rate. I mean, they talked about it time and time again, which is they're aiming for an unemployment rate of about 4.55% to take the steam out of the economy and sales. And I know that is a horrible sort of thing to say, and all the news articles, I'm loving the headings at the moment. It's like sack him, fury him out to RBA. Out of touch, mamma mia. Women's agenda, work more, cut spending, out of touch. So he's been saying the same thing, which is he thinks people need to spend less, start saving more, and cut down on consumption. And I don't think the sales figures are showing it. I don't think. I think we're starting to show like inflation is becoming more entrenched into the economy, which is something they don't want to do. And while they've got the levers of unemployment to play with, I don't think he's going to keep pressing the button. Whereas in the US, you had unemployment jump from 3.3 to 3.7, which was a good result somehow. In terms of, I think it was going to get higher. But there's some analysis on the jobless report there where they've been adjusting it for excess deaths and seasonality. The last couple of job reports, and so it'll be interesting to watch what the analysis flows through, because they're thinking that their unemployment rate's probably more so in the 4s, and that's because a lot more people are going for coming back off the 6 weeks and applying for. It works a little bit different in the US how you actually calculate the unemployment rate and get support from the government. But in Australia, I think he's still got some length of time to go before And so they probably are going to keep pressing the button because they don't. The last thing they want to do is have inflation get entrenched. That's just the last. Arnie, back to us.
Yeah, you stimulated a few little thoughts in the old brain hole there for a second when you're talking, Brad. And I know, interestingly, one other thing that's been mentioned a lot by the RBA in particular, and then some of the media the pundits have picked up on this, is that corporate profits are also going to all-time highs or close to all-time highs, like record profits, at the same time that our stock market is almost reaching all-time highs. And then you're getting this rhetoric coming out from people like Governor Lowe and the media saying people shouldn't be seeking wage increases, corporations shouldn't be giving wage increases because that's going to fuel inflation. And what do they mean by that? It's a phenomenon which has been documented in other countries where they've had high inflation, which is called a wage price spiral, where they do get these large increases in profit. We see these large increases in cost to the consumer. The logical...
Well, people demanded at that point in time money. Well,
the
higher profits. I'm paying higher amounts, so I need equal.
It's logical, right? Like if I've got rising cost of living and you got more money to go around, then that money should go to me or some of it, right? But people say that fuels inflation. It all comes back to what all three of us discussed on the pod before the inflation really hit, and we were talking about the supply chain crisis. Inflation is a phenomenon of supply and demand not being equal. And at the moment, we are heavily focusing on the demand destruction of interest rates because that's what's having to occur. And it's really the only lever that central banks can pull.
That's only one.
But the other side of this coin is this really the way to get out of inflation? I would say, my opinion is no. It's a short-term fix, but the real way to get out of this is growth. And that's always traditionally been the way to get out of it. So you need to grow with efficiency at a lower cost and get supply to outpace demand to bring prices down. That is the way you would solve it for the long term. But
Arnie RBA.
But thank you very much. But at the moment they're doing what they have to do. So yeah, we'll see what happens.
And the only thing they do have to do, well, the only lever the RBA has is interest rates. Whereas this is more of a physical government one to fix. Anyway, Jolie, over to you, mate.
Yeah, no, because I think great points there, guys. I think unemployment's just ticked up a little bit in Australia. It was at 3.5, which is an all-time low, maybe 3.6 now, 3.6.
Yeah, 3.6 as of May. Yep.
So it's still tight. And I was reading something the other day, which I hadn't come across before, was an economist article. It talked about inefficiency in labour as well. So you can have tight labour market, but if it's not efficient per hour, that leads to Arnie's point. It's got to be efficient. It's got to be growing. To ensure that the market's working itself out with supply and demands, because you could have a tight labour market with inefficient workers because it's just there's enough jobs out there to suck up the inefficient people that aren't going to output as much, which then creates an inefficient economy. So without getting too technical and digging into jargon, it's a fascinating time at the moment, and we've got about same article 400,000 net migration this year.
I was just about to say that.
So. That's going to bring a lot of it will be students. There will be some skilled migrants in there, and there'll be a lot of students in there that they'll, for one, suck up more rental accommodation, and then two, they'll suck up more casual jobs and more jobs. So if the job market is already tight in terms of there's more employers seeking staff, then that's going to get even tighter. So it's going to be an interesting time when it comes to the economy, and I guess, as you said, it's the only lever they really have is interest rates, and they've got to try to act quickly because they don't want it to become ingrained, and they don't want people to start accepting these prices. Look, I think discretionary spending is coming down a bit, and I think people are feeling the pinch when it comes to fixed costs like your rental and your mortgage. You can't do much about those costs, and rental's one of those things. It's unfortunate that that's sort of more of a government inflicted type thing with undersupply of housing. So rentals just ramped right up again in terms of cost of living, and it's a large chunk of that cost of living for the normal discretionary consumer spending. So yeah, there's so much to play out still. I still think that interest rates by Q1 of 24 we'll be starting to talk about them coming down.
Yep. Yeah, I reckon.
So
I think that's on point. And I'd say to the people in the thing is watch the government's bill currently. They got shut down. They can't be for the double dissolution around community housing and building That's going to be an interesting one with the Greens starting with the Libs on that one, the coalition, to knock it down, and that's the government spending $10 billion over the next 10 years and creating a fund to create more housing. And the Greens are saying it's not enough. They need another 10 bill, another 30 bill. I think they'll say. So it'll be an interesting one just to watch for the housing prices.
We'll see. Will it be enough? I think government only accounts for a small percentile of community housing at the moment. The large
this one's obviously going to be shooting that up.
90% plus is privately funded by people, property investors. So,
do you know much about this one, Joel? The new fund getting created by the government for low income housing.
Say again, sorry, Brad.
Do you know much about this one? The government's $10 billion fund that they're putting together for what's going to be more now. To build low income, build $1.4 billion worth of housing a year.
Yeah, I was reading about it the other day. I don't know what percentage that'll then allocate to them as them funding kind of housing for rentals. So I think at the moment they're less than 5% is government funded housing, and 95% is made up of private mum and dad.
Well, it's more like the when they approve a new building, they say that to the developers, you have to make 10 or 20% of this building low income.
Yeah,
that's what it usually is. So that makes it more private driven. So like in the same development in say Richmond at Hamilton Marinos, on the river there, you will get kind of 5-10% of those beautiful apartments going in for low income. Just the way it is.
And I don't know if they've investigated the what is it called, the American setup of the buy to rent.
Build to rent. That's happening here in Australia at the moment. Build to rent is happening with the big developers. It's not really the government. It's all like the big developers are doing that, seeing it as a sturdy 8 to 10% a year on year investment coming up. And it's going to be interesting to see what happens over the next kind of 3 to 5 years in Australia. What alleviates the issues.
Well, they need to stimulate that area of supply, because if people haven't got housing and accommodation, you've got homelessness, which is not good for any country. And then if you're trying to build migration up and you're trying to get people to come here, and to grow efficiently, if you can't supply them with housing, they won't come. And people that are already here won't be able to afford to live. So they're going to do something about it. So anyway, that's a big macro thing, that one.
Anecdotally on that, boys, just on that little thing. I can't remember if we discussed this on the pod, but I was having a chat with a mate of mine who was talking about buying an investment property down the peninsula and Airbnb-ing it for the times of the year that they were not using it as a holiday home. And it got me reading about the issue, not just in Australia, but globally, about how towns like that are struggling to support the workers who work in like the local jobs in the cafes, the supermarkets, the hairdressers or whatever, because there's nowhere to live, even from a rental perspective, because everything is like, a lot of the majority of those properties are used as Airbnb now. So I do.
We'll think about doing that on transport to go to Phillip Island. That's why we're in Perth looking at the engineering of it, because the return on investment you can get now putting structures on property compared to like normal rent is crazy. So they've got to do something about it.
But it's an interesting one, because you've got to sort of forecast out like how long will you get that yield for before the local economy collapses, and then no one wants to go down there anyway because there's no amenities and services. So it's interesting.
Place like Phillip Island's not going to collapse.
Well, mate, it depends on how far it tips. Like,
good. I'll never say never.
Would someone want to commute an hour to work at a coffee shop on the peninsula if they're not living there?
Yeah,
you know.
What's taken there, Arnie?
Oh, that's an interesting one. So we'll see how that plays out. But yeah, so what? So next topic, boys. What is it, Jolie?
Yeah, so we're going to kick on to, I guess, just in terms of the next bit, before we get to some of the AI conversation and what spurred this market. Just
Magnificent Seven, yes.
From an economic side of things, just off the back of interest rate rises, the recessions that we're starting to see occur now. So I just jotted some notes down there. I think we've seen New Zealand record 2 consecutive quarters of negative GDP growth, and I think they had a revised figure in there. So they're technically in a recession now. I think the US, we said we're bordering on one.
Bordering, but not yet.
It's expected.
Expected early next year. So the UK and the US are poised to fall into recession Q1 next year, they think.
Yep, and I think other countries in Europe may already be there as well.
Germany is, Jolie. Yeah.
Yep. Yep. And then and another tidbit I found out the other day, I didn't even realize interest rates in Japan are still at zero. They haven't raised interest rates.
Love it.
It's fascinating. They're a fascinating economy. They're an outlier.
It's what demographics is. It's going to be. If you want to have a look at demographics, that's Japan. Obviously, was the first country to go through heavily stuff, and South Korea to follow, and China to follow, and then Germany. It's going to be interesting. The next 30 years, demographics is going to play such an interesting role in global economics because we won't go into this episode, but we'll do a big episode on demographics. It's going to be big. But
Well, Japan is very old.
UK obviously has got the same. They're a bit scared with their debt cliff as well and their mortgages, so they've got even more than Australia's coming off in the next 6 months, coming off their variable rate onto off their fixed rate onto variable as well. So globally, it is heading down the recession path.
Yeah, and Japan's historically had an older aging population, which was back in high school. I remember, this is 20 years ago now, feeling very old. That was the case with Japan. They were low interest rates, and they'd always struggled to spur economic growth, GDP, and inflation. So it didn't surprise me they're still on zero interest rates. But it was fascinating in the current environment where everyone's raising all around the world, and they're still at zero. So so that's sort of and where Australia will be from a recessionary standpoint. There's a decent chance now. I think if we're tipping the scales, it's probably over 50% chance, but not huge in favour. But I think there's a chance we'd slip into recession. It may only be a light, mild recession because of the bolstering of our economy and the commodity prices probably helping energy and lithium and the likes. Those things are sort of helping, I guess, maybe keep us out of recession. But we may go into a mild one.
Yeah. And I guess just before we do move on to the AI stuff, it's just worth mentioning that the Federal Reserve in America did hold their funds rate at 5 to 5.25%.
Hawkish pause only.
Hawkish pause, as you mentioned, and they did say that they signaled that they might have 2 further rate hikes before the end of the year, which would bring their rate up to 5.6-ish, I think.
Hawkish pause.
Yeah, it's an interesting one because I think we discussed a couple of pods ago whether or not it would be hard landing, soft landing, or a no landing scenario.
He's on Wall Street running a real way with anything. He's just like, I'm letting you know I'm still being hawkish.
Yeah, I mean, you and I, all three of us actually have discussed at times some of the things that are occurring and how it doesn't really make sense that the markets are rallying to all-time highs because there's still a lot to worry about. But
you'll be right.
But at the same point in time, if America can thread the needle and hold rates at a sufficiently elevated level while they see inflation coming off and grow the economy, they might get out of it. It depends on what's going to occur with this commercial real estate debt war, because we've already seen the banks fail once. That could make the banks fail further, and that crisis is still playing out. So it's interesting.
And some of the commentary just quickly on that I read was fascinating with the hawkish pause and the threat of future rate rises. The markets are even predicting that he's throwing that out there as a scare tactic, that he won't raise again. And it's more to say, stop spending. You're going to get more rate rises if you keep spending. And
that's what I honestly believe is that.
You're going to be in more pain. So whether that's a similar thing with the RBA as well, like the RBA is going to have to come off the back of what other countries do to an extent, but whether they're throwing out like an angry teacher or a parent, stop spending, we're going to keep raising, you're going to keep getting in trouble. So maybe it's a scare tactic, but we'll wait and see what comes of that.
I reckon they take powers about the bluff.
It might be a bluff, but I also wonder when it comes to this kind of thinking amongst people who run the show at the Federal Reserve, they know that it isn't an instant gratification thing where they raise rates, problem solved. They know they have to get it to a point and hold it there. Like Jay Powell said that multiple times, but all the time, whenever there's like a slight backslip or a bit of bad news, people always get on the front foot and go, no, need to hike more. It's not happening fast enough. Well, it's not. It doesn't happen overnight. It's a gradual thing. So,
you get off the Jay Powell.
Yeah, I don't know. I don't know if I'm a big fan of his. I think he's always acted late. But at the same time, if he pulls off a no landing scenario as the Fed chair, he might be the greatest Fed chair of all time, even if I don't like him. I do think he's made some mistakes, but can't Can't you got to give credit where credit's due. So if he
You
pulls
mean
it
if he
off,
pulls off a soft landing? Sorry, Arnie.
I mean a no landing jolly. Like if their GDP grows and they get inflation back down to their target rate, and they avoid any of these catastrophes that we foresee on the horizon, like the commercial real estate bubble popping, they might not have any landing. They might just take off again and just go back to
No landing issues, just in and out.
That's right. Just a little dip and then back up into the sky.
Unwind their balance sheet, bring inflation down, and just land it beautifully.
Don't even need to bring out the landing wheels. Just keep them up. Keep them up.
Pull up on that stick, J Power. But I do think, Brad, you just touched on it though. Like, there's so many issues, and the balance sheet and the amount of debt they have is like astronomical. So, do I believe they'll do that? I don't know. Anyway,
on the AI guys. So we were chatting before the podcast, and yes, again, we prep before this podcast. We get all our facts and figures out, thanks to Google and thanks to some information that we read during the week. And Brad had an interesting tidbit on what's been pushing the market, but more importantly and interestingly, in the current environment, it's not necessarily what's pushing the index is being pushed, but what's underlying of that index and how minute the specific shares and stocks are that are pushing the whole index. And I guess we're referring mainly to the S&P 500, which is the Standard & Poor's 500 top 500 companies in the US, and the NASDAQ as well, which is the tech side of things. So, Brad, did you want to talk a little bit about how that's been, I guess, this calendar year, how that's run so heavily?
Yeah, I think they're dubbing it the Magnificent Seven. So, so we're talking about Alphabet, Apple, Meta, Nvidia, my gods, Amazon, Microsoft, and Tesla. Those 7 stocks have a surmounted of over 90% of the S&P's 500, the top 500 companies, 2023 rally. So the rally this year in the S&P 500, 90% of that can be allocated to those 7 stocks. So they're the 7 stocks index is up 4.2. Sorry, the S&P gains this year is 2.4 trillion, and of that, 90% of that is those seven stocks. Apple's $500.9 billion in added market cap is by far the greatest of the 7 stalwarts. Though each stock is up more than 20% year to date, with more than 175 billion in market cap gains apiece. Amazing. So, I mean, look, you got to remember the Nasdaq and these tech stocks, the first ones to get absolutely smashed.
Yeah, I was going to say that they came off.
And they came
off a tough 2022, didn't they? Interest rates and whatnot.
You had your multiples and all that just absolutely smashed on these. With interest rates coming up, growth stocks got leveled because as a part of the growth stock, calculation of multiples there, obviously the cost of interest rates gets factored in over the longer term, and even if they perform at the same amount, then over a long period of time, your overall kind of growth multiple goes down. I'm happy with this because we're going through a couple of raids with Hammer Tech at the end of this year, and the longer this lasts, the better. Because hopefully we get some re-ratings for. That hasn't happened yet, but hopefully we get some re-ratings in the private markets off the back of the stocks and their gains. But I think it's
is the market. Do you think the market is predicting and saying to us that the AI game that's coming into play here, the artificial intelligence, is far greater upside than what these short-term interest rate issues are that these tech companies are going to be seeing?
I think it's one of the underlying. I think the market is saying that we missed. I think we missed a few things. I think the market's saying that we missed how big of change AI is going to have on the overall.
I read the other day that they think that AI is just as big, if same sort of bigness as the web coming, like the World Wide Web back in the 90s. Like
they're saying that AI could add $16 trillion to the global economy by 2030. Right? Some people say generative AI alone, 4.4 trillion by 2025. That's PwC and McKinsey and stuff. Look, at the moment, the markets are saying there's obviously a large misread by both the people that were leading AI and also the markets around how much of an impact it will have on productivity and I guess add to the global economy. And at the moment, that's why the markets have rallied around the tech stocks, right? Because they're obviously the ones that it's going to be most applicable to, are the ones that are going to be in the best position. Also, I think Google being the leader in AI, I think one of the good things that has played out is Google being the leader in AI in terms of the application language, so not in terms of their hardware. But that's obviously where NVIDIA is crushing it at the moment. NVIDIA seems to land into like crypto, and then like crypto goes big, and then crypto dies, and they land in AI now. And NVIDIA just seems to be like knocking every like unicorn that pops its head up. It's just like another unicorn out to the little stallion. But I think you've got Google when OpenAI released and kind of beat Google to the head in terms of the race and the release to the general public, because Google were a little bit too scared for what backfire could actually have on their business initially.
That was Microsoft's ChatGPT, yeah?
Well, OpenAI was a company that started off, I mean, Elon was one of the original founders of it. And it started off with the idea that, it was going to be open source AI. And then over time, Microsoft made a $1 billion investment, then a $10 billion investment. And now it's not sort of OpenAI. And so they released the market and I guess wowed the world with what is possible. Google slipped at that point in time with its own launch that week. But then what happened you saw is like ChatGPT and then ChatGPT 4 come out, and then you had a couple of other things come out around like other tools to blow the market away. And then Google came back after that and said, all right, we're really launching now. And we've got our stuff like lined up. And then it came out and blew the world away again, right? Saying, not only can you do this, but now you can do all of this. Here's our Google connected world in which we've been playing this for the last like 5 years. And I think that's what's really blown things up, which is the smaller company kind of released to the market and tested and take the risk, and then you had, when I say small, I mean they're still taking on billions of dollars investment, but then you had Google come back and say, this is what we've been working on for 5 years. Now we're ready to launch it. And here's the power across all our applications that you haven't even seen yet. And this is what's coming. And then you had NVIDIA release kind of some of their new hardware and what's going to be possible using generative AI in terms of speeding up their performance. And I think it's just shown in all these different facets how much it's going to be touching our lives over the next couple of years and the significance of it. So we're not just talking about like increases of 5% and 10% here. We're talking about like orders of magnitude greater. And so that's my quick spin on it. I think why the market missed it. That's why I think it's built money back into it. I think like anything, it's just my personal thoughts and general advice and all the rest of it. Just like the internet boomed in the early 2000s, and every man and his dog and lady with her cats put money into Cisco, thinking that Cisco basically owned all the underlying infrastructure and routers and all the rest of it. Cisco was the hottest. Cisco was the NVIDIA of the early 2000s. There is a way of sometimes overstating how quickly we're going to move to these things. And look, things are getting quicker and quicker and quicker, but we have a habit of creating bubbles. And so I think it's going to be an interesting one to see if this one, we've totally underrated it again, and we are going to be adding 16 trillion, and therefore we've still got so much growth left, or if we've like shot ourselves an injection of $2.4 trillion worth of added value into the markets, thinking that value is going to come, and it doesn't necessarily come as quickly as it should. But anyway, that's enough for me talking. Over to you, Arnie.
Arnie.
Yeah, it's an interesting one, and I think what we're sort of seeing, and I know that all three of us on the pod have given a perspective on this in the past about what the future holds. And just for disclosure purposes, I hold Meta, I hold Tesla, and part of the play and I hold Intel, and part of the plays with those stocks, I don't hold Nvidia, sadly. I wish I did, but I never found an attractive price. And at the moment, its current valuation is too rich for me based on the prospect of potential future growth. But it's funny for me to say that because I've done a lot of debate and a lot of argument around Tesla around this same sort of point where people will say, well, Tesla's valuations are too rich. Why don't you sell out? or why didn't you sell out when it was at its all-time high?
Because you love Elon.
Well, truth be told, I did think about selling out of Tesla when it hit all-time highs, but he didn't let it stay there for long enough before he opened his mouth and crushed the stock value, and it was back down. And I thought, well, I've been here before with Tesla dropping, like a lot, so I'll just hold, because I still do have conviction in Tesla. And when Brad talks about
how far off are they from their high, Arnie?
At the moment, I think they're about. I haven't looked, but I think they're trading around 270 a share, and I think it got to, because there was a split that happened in between there, so I forget what it was, but I think it's all. Let me actually, Brad, can you have a look what the all-time high for Tesla is? While I
I will look at it now.
Thanks, mate. Yeah. So what I was getting at was these AI stocks. I think they're going to attack different parts of the market. So you've seen things like Microsoft, OpenAI, and Google Bard have these large language models, and they're going around that direction. And I know they've got other stuff going on as well. Like Google, for example, had Waymo. I don't know what the status of that is, or they were trying to do like
sorry.
Yep.
409.97.
Yeah, 409. So it's
so we're a good let's say 40% off.
Yeah. Yeah, so they were trying to do that. But the way I view it is you've got these like companies doing one like specialty. So they're doing like the large language model or the stable diffusion kind of things with the prompting, and you can get text-based generations or picture or video-based generations. Then you've got things like Meta and also Apple with their release of their headsets, who are going into this metaverse function, which I think will be ancillary to AI. I think AI is adjacent to metaverse and this new way of computing. I think they're envisioning that, the old traditional desktop or laptop will probably go away, and we'll just have these goggles that will be a computing system. Then you've got things like robotics. So you've got like Boston Dynamics, you've got Tesla, among others, who are trying to solve for like the robotics arm of this. So cars being self-driving, and obviously Tesla is nowhere near the leader in this, but they've got the biggest. So when I say they're not the leader of this, they don't have the most advanced self-driving system, but they do have the most real-world data at a level 2 training set because of their full self-driving program. So in theory, if they get approval, they could ramp up quickly. But at the moment, they're not the leader. But they've got that aspect, and then you've also got their Optimus robot, which at the moment it's a bit of a meme. People laugh about it. They say it's not very good. And we have, and truth be told,
pretty dodgy.
Well, truth be told, we haven't seen a lot of what it can do. And when you compare it to something like a Boston Dynamics, where they released that video of that robot doing flips and throwing heavy tools and stuff around, like you could see the real world utility on a construction site. Obviously, it won't be able to do like fine motor skill things, but it will be able to lug heavy shit around that's not breakable and help humans. So when you've got all these parts converging into AI, I do understand the hype. There's huge potential for growth. It also is a convenient, easy answer to a lot of the problems we talk about. Like we were talking about demographics earlier and aging populations, how that would affect everything and how that would affect growth. Well, if you've got AI and robots coming through that can do the work, and then we can focus on taking care of people in a healthcare sense, it's an answer to those problems. Yeah, go on, Brad.
It's actually really interesting. It was just a conversation I was having yesterday about how far, I guess, generative AI and robots are going. So we got for lunch yesterday is looking for investment and in the Ag 4.0, so farming space. And basically they've come up with a platform that takes in all government mining data, farming data, all the rain data, all the weather data. It uses satellite data every single day that goes over the top and can work out moisture. So if there's any leaks going on, it uses AI around pest control, so it can work out if you've got like a fire ant, blow out over there, or you've got crop whatever over there. And then it sends a drone, and instead of you spraying your whole field now, it just goes in and like just locks onto like that 4% of the field and isolates like the pest problem more, knows you got a water problem and fixes it there rather than fixing it across the board. And they're saying like, it reduces input costs, and that's what farmers really, where a lot of money goes. It reduces input costs up to like 90%, and also we'll be able to tell farmers what to plant where, based on like taking samples of the soil using drones and measuring the carbon content, the rest of it, and working out for the next 3 years this is the best crop to grow per acre and the rest of it. So that's the sort of stuff I think that is happening right now that we're not even aware of. That I think this this robotics and AI kind of is coming into play. It's coming into play everywhere, and it's kind of it's fascinating. So I just wanted to and that's something that's happening now. It's not like futuristic. It's not like it's working. So
it's a great wrap up to this topic. I think if we tie a bow around it, because I'm cognizant of time.
I want to say one more thing, Jolie. Just anecdotally, which is very funny. Our mate Horry sent me a picture today from Wall Street Bets saying that on the Kroger earnings call, which is for people that don't know, it's like a supermarket chain in America. They mentioned AI 7 times on their earnings call, and it's like, what could they possibly be doing? But like, it's a laugh, right? But hearing what you were saying about farming, Brad, there probably is applications for AI in supermarkets. But anyway, we'll cover that another day, Jolie. Carry on.
Brad, if you can give me some screen share action, mate. I've got one thing to share with the listeners out there, hopefully the watchers out there on YouTube. Apple Vision Pro goggles and Macho Man. Is it Macho Man?
Yes, Macho Man Randy Savage.
Always out of his time. So he should get some kind of royalties from Apple for stealing his copyright of his.
And you can see the eyes as well, like the Apple ones. That's amazing.
So,
that is so good. That is so good.
But I'd share that one with the listeners. And just to tie a bow around this and probably jump on the back of Brad's there is, and Arnie probably would have heard of it as well, is there was a chess championship back in 2016, I think, with the World Chess Grandmaster versus an AI chess competitor, and the AI beat the human. And I think interestingly, a tidbit to that is the human got put off by the AI's move, but it was an accidental move. It was a very unusual chess play, which it was actually turned out to be an accident. But anyway, on the top of that, this sort of article podcast I was listening to, it was more of an advisor type and an SME type one as to where AI will come into play with businesses. And they sort of use this chess example as a good point. Is AI would potentially in a scenario be greater than human by itself, but human with AI intervention or AI extension will be greater than AI by itself. So it's a fascinating
augmentation is going to be huge.
Yeah. So it's a fascinating thing as to where AI as an extension of the human, how much more efficient and powerful and better at business and better at things we'll be able to be. So I think we're only scratching the surface. So we'll see where it goes, guys. But great topic, and I'm sure that'll come up more and more again. So listeners, any questions you have around that, feel free to reach out and hit us up.
I think we move on to crypto next week, boys.
Yeah, for sure. And
we'll move it out 50-50.
Any rapid fires you want to hit
rapid
up
fire, sorry,
or do you want to?
We'll do rapid fire.
Yeah,
I'll do rapid fire quicker. Then we'll do the quick Q&A, and then we'll do 50-50. So it's not many. Pardon me. There's not many rapid fires today. So the Pentagon has said that their Ukraine accounting error has revised up to $6.2 billion. Blinken has said that the US does not support Taiwan independence during his China visit.
Big one.
Intel is going to build a $25 billion factory, its largest foreign investment in Israel. So that's in addition to their massive foundry investment in America. Musk says Twitter's video app for smart TVs is coming. Goldman has called markets too optimistic on the pace of the inflation drop. And Binance has made a deal with the SEC to move all US customer funds and wallet keys back onshore.
There you go. Great rapid fire.
We'll continue that conversation while they've done that next week. So watch this space.
Good. Bit of crypto. So yeah, in terms of the listener question this week, we did touch on briefly with interest rates and whatnot. So the question came from Mark. Home loans coming off fixed loan this year. I think it was towards the end of the year he mentioned. Is it a good idea or viable to refix again, or is it viable to flick over to a variable? And as we always say, it's general nature and seek your own personal help or personal advice. But I guess when it comes to fixed rates more broadly, when we're coming into an environment where the rates are going up and up, and we're getting to a point where maybe they're getting close to their peak and you're coming off a fixed loan into a higher variable, if you were to lock again now, you're potentially locking in at a higher rate cycle and higher rate environment. And you can sort of see that, I guess, they tempt you with a 2 and a 3 and a 4 year fixed loan at potentially a lower rate than the variable. That's because the actuaries behind the scenes are saying we're going to get a win off that if this consumer locks in at a fixed rate that's discounted to the variable that they're going to get now, because we see where the rates we feel are going to be going in 3 and 4 years. So that's always a good indicator to say, well, okay, if the 4-year rates are actually lower than what I'm going to flick over to a variable on, the actuary is saying that they think rates are going to be back down here or lower at a variable at that time. Obviously, individual circumstances change because some people might need to know and need to have a definite outcome of what their loan repayments are going to be, and they can't afford to have. And that's a personal situation that is obviously different person to person, but that's just more broadly in terms of interest rates and how the actuaries work and how those fixed loan, those fixed loan enticements come out of 3 and 4 years to say you can get 5.5 as opposed to flicking over to variable at 6.5 or whatever it may be at the time. They're just my 2 cents on that. Anything you guys want to quickly touch on with the rates for Mark?
I got something to say. I'll go first. General in nature, but if it were me in Mark's situation, I would not be thinking about locking in. And in my own personal situation, because I was planning on selling and buying, I didn't lock in even at the lows, even though I was well aware and cognizant of it. And I have to ride the variable rate rise. But I do think cuts are coming sooner rather than later. So yeah, I wouldn't be locking in. I think this is near the top, even though there probably is a few more rate rises, but I think we're near the top. You know, what can people do if they're going into mortgage stress? Potentially, you could be thinking about interest only. You could be thinking about refinancing at the same rate, but getting a buffer in cash to tide you over. You could be thinking about
you can flick your refi over to a longer term, so that then stretches the loan out. So on top of what Arnie was saying there, if you've got say 22 years to run and it's starting to get tight, you want to flick it out to 30. That'll reduce your repayment amounts as well, and potentially get a lower rate, potentially some cash backs. Banks are always keen on business, and lenders are keen on business. So
you can have a chat. You got to chat to your bank too, right? Like they can help you out in certain niche short-term scenarios if you're under mortgage stress. So I'm not suggesting Mark's in that scenario, but that's just things that pop into my head when we talk about this issue.
Yeah.
Rattles?
Yeah, I think you covered them off. I think the key is, I think that you can take your loan over a long period of time to reduce your dollar amount. If that's certainly stressing you out, you don't necessarily have to lock it in right now for a higher amount. I mean, with the forecast that we've probably only got maybe a couple more to go, I wouldn't say who knows, because we've seen a few rate rises, and we don't know what's going to happen in the global economy. But I think you can err on the side of we're not going to have it another 13 in a row probably. So unless the rates they're offering some sweet fixed rates over a short period of time, like 2 years, I wouldn't be going anywhere near it. I've had some of my friends have like significant kind of offers over 2 years, and obviously that's the actuaries there going, oh, we think we're going to have a bit of a play for X amount of money, in our portfolio and hedge X amount into that category. And I'm like, yeah, if you get that, like, about 150 basis points off where it is now, I'm like, over the next 2 years, grab it, because I don't know if we're going to be back down 150 basis points anytime soon. But I haven't really seen too many of those situations where it makes it look like we might be coming back down early next year, and a couple of 25s here and there. So
assess the risk reward, and I think you're right there with a 1 or 2 year fix. The risk reward's not as significant as maybe doing a 4 or 5, and you end up being well above what the variable goes to. So do your due diligence, and just think of debt as the underlying asset is generally property. And it's a short-term pain for hopefully a long-term gain. So getting yourself through a short-term period of pain with higher interest rates, and maybe we're at the peak, maybe they've got a few to go, but then long-term gain is getting through that period with some of the different options that Arnie's just mentioned there and Brad, to allow you to be able to stay in that asset class for longer, and that'll help work its way through and work itself out in the long run through wealth creation. So general in nature, great question, Mark. Very topical. Very a lot of people doing it tough out there. So it's a great question, and just people in general wanting to know about loans and what they mean and how they work. So in terms of the 50-50 this week, boys, we've got a topical one which may not be cut and dry. It might be cut and dry for us, but there's I think there's some debate out there in terms of the long-running series of comedy sitcoms. We've got the two main big ones, Seinfeld and Friends. where do you guys sit on the ledger of Seinfeld or Friends if you're only able to watch one of those sitcoms for the rest of your life? Which one would it be?
I'll take it. Seeing as though I was showing Kramer and the underground horse shower salesman, we're going to go Seinfeld. Just because there's just too many everyday human traits that need to get a light shine on them, and it's still hilarious today. Don't get me wrong, Friends is awesome. Love Friends, love it. But, Seinfeld.
Yeah, I think Seinfeld is a top 3 show all time, any category, not just comedy. And I do like Friends. I think Friends is funny. I think it hasn't aged as well as Seinfeld. I think Seinfeld has aged really, really well. Like, you can still watch it and it's hilarious.
It's still applicable.
It's so good. I've also heard people say like they prefer something like Curb Your Enthusiasm, and my answer to that is always like, yeah, I love Curb as well, but without Seinfeld, Curb wouldn't exist. It's like,
I don't even know what Curb is.
Curb Your Enthusiasm is Larry David's show. He's one of the creators of Seinfeld. It's a very similar comedy, but it pushes the boundaries because it's sort of like it's like a more modern, more cringe version of Seinfeld. It takes some of that cringe comedy aspects, like the Office and stuff, made famous. Whereas cringe comedy, it's got its place, but I think that will age poorly. I feel like Seinfeld is classic forever. So I'm Seinfeld all the way, Jolie. I'd put Friends in the bin in a heartbeat.
Yeah, Seinfeld all the way for me. I think you get 10 seasons as well, whereas Friends might be 6 or 7. So you've got more breadth of series to get.
Well, it wraps it up beautifully.
But I think chatting at poker on Friday night to one of our friends, Snowy, shout out to Snowy, he was Friends all the way. So we'd love to hear from listeners to see whether this is more in line with what we think. It's 3-0 here, or it's 3-1 if we include Snowy, or is it more of a 50-50? So interested to hear their thoughts and rhymes and reasons.
Oh, special guest on the pod.
Yeah, it's a polarizing topic, Friends versus Seinfeld.
I would love to call Snowy for a 50-50 segment just one week and just call him and ask him. He could be the unofficial 4th 50-50 member.
Bring him in. Should have brought him in today. Yeah. Great, guys. So coming up in the pod next week, we're going to touch a bit more on the crypto, what's been going on in the world of crypto, the ups and downs of that, what's happening with Binance, why they've stopped accepting AUD
where's your cousin, mate?
payments.
Where's your cousin?
Very interesting. And also we've got a friend and colleague or friend of ours that Arnie met as well on Friday night, Ash, who's an investment advisor who deals with high net worth and investments specifically for individuals and structures. So we're going to get him on to talk about the investment world and what's coming up, and just a macro view and some of the interesting investments that they keep an eye on as well. So I think that'll be quite good and topical for the listeners out there. So without further ado, we'll tie a wrap up around this episode today. Listeners, where can they get us out, Arnie?
Yeah, get us at Money in the Tank on YouTube, Instagram, Twitter, and Facebook. And please leave a like, comment, subscribe on YouTube, and hit the bell.
Absolutely. And we'll be back next week with episode 66 to bring you guys all more things in finance and money and anything fun and exciting, and I'm sure some more 50-50s and roof controls as well. So look forward to seeing you guys then.
Cheers, boys.
Thanks, guys.